Our generation is feeling completely screwed. Like we are doomed for the rental life forever and can never build equity on our own land. It's just seeming impossible to save enough money for a down payment on a home when everything costs so much money. I mean, you just go to the store, buy a few essential items, and you're down at least $60. So, how can we ever secure our future in this economy and moving forward? Well, you're gonna save your future self a whole lot of stress and frustration, and you're gonna watch till the end of this video so you can start securing your dream right now. I'm Leah, I'm a realtor, not a financial advisor, so take inspiration from this video, but make sure to do your own research on what is right for you. So let's break down some beginner level investing strategies so you can start growing your money. Okay, so first up we have the high yield savings accounts. There are plenty of online banks you can open up a high yield savings account with, but make sure to read all their requirements, what APY they offer, and overall the functionality of the platform. APY stands for annual percentage yield. It tells you how much money you can earn in interest from a savings account in 1 year, and if you don't add or take out any money. For example, if you put $10,000 in this account and it has a 4% APY, you'll earn over $400 in interest in that year. Not only do you earn interest on the money that's in your account, but also on the interest you've already earned, which makes it compounding. So APY gives you a pretty good idea of how fast your bank account balance can grow. When you research online, you'll find companies offering high APYs like close to 5%, but they will require, for example, a $5,000 deposit. Or you'll find ones that require linking direct deposit like SoFi. Many banks promise high APYs, but they can change at any time. That's because they depend on the Federal Reserve's interest rate decisions, which fluctuate a lot. If they lower the interest rates, banks tend to lower their APYs as well. So that makes savings accounts variable APYs, but fixed APYs, which do not change their rate at the term of the account, are also a thing, which I'll touch on next. You do not want to miss that. I opened an account with Ally, which when I joined said they would give an APY of 4.20%. While that did last for a while, 9 months in, it's at 3.80%. I made around $93.42, so that means I got paid around $10 to $12 every month. Now, it's only a portion of my saved money as I don't want it to all be in one place, but of course, the more money you put in, the more you'll get in return every month as it does compound. You can schedule automatic withdrawals from your savings or checkings account like every week or month, whatever your goals are, and just sit back while it snowballs. There's also only a few amount of times that you can deduct money from your high yield savings account, so it's better just to not touch that money. So only put aside money that you're willing to invest in the long term for it to allow it to grow properly. And it's not the biggest return, but it's better than having your money sit in a savings account, a regular one, that only accumulates a few cents every month. Might as well get some free money while you're at it. And if you have a partner or a family member that you want to save up with, you could grow your money twice as fast by opening a joint account together. And I'm curious, comment down below, what is your favorite high yield savings account and why? Let us know, what are the options out there? Number 2, I did say I would talk about an account that has a fixed APY, so a rate that does not change for the term. An example of these are CDs, also known as certificates of deposit. This is a simple long-term strategy. You deposit a chunk of money into the account and wait for a certain number of months or years. This is what is referred to as the term. And you don't touch it. You just let the money sit there after your first deposit and let it grow. You can't add money to most CDs. Usually, if you withdraw your money earlier than the CD's maturity date, then you'll have to pay a withdrawal penalty fee. I mean, it's not necessarily a bad thing. It might incentivize you to leave your savings alone. So only put money into a CD that you don't need. You're not gonna touch it. It's gonna be like an emergency fund. The rates also differ depending on the length of the term. For example, you'll see if you search online that the APYs go down the longer the term gets, and you're probably wondering why. Well, banks don't want to get stuck with a high rate in case the interest rates drop significantly during the CD's term. they know how to keep themselves safe. If you aren't interested in tying up your money for years at a time, consider CD laddering. So this is a strategy where you open up multiple CDs with staggered maturity dates, so some of your cash is available to use or roll over at regular intervals. So that way you can take advantage of the higher interest rates from longer term CDs without having all your money tied up for 3, 5, or more years. CD ladders do sound complicated. I mean, you're gonna have to go through all these different banks and buy the high APY CDs and do all your research. Well, if you want to cut that headache down a little bit, you can check out Fidelity. They have those CD ladder options already available and made for you. So you can pick through different banks as well to find what works best for you. So that's something to look into. And if you're finding this helpful and you want a more in-depth video about CD ladders, click that subscribe button below and stick around for more videos. Number 3, we have T-bills or Treasury bills. They're a super safe way to save and grow your money. So here's how it works in a simple way. T-bills are like a loan you give to the government. So you let them borrow your money for a short time, and in return, they give you back more than you gave them. So how you make money with T-bills is that they are sold for less than their face value. So you essentially buy them at a discount. Then when it matures, the government pays you the full amount at the end of that term. So essentially, you lock in what you're going to make when you buy it. If you pay for $950 and then it matures and it becomes $1,000, you get the difference, which is $50. Since you're lending money to the US government, it's considered one of the safest places to park your money, as the government is unlikely to not pay you back. And they don't last forever. You can choose how long you want to lend your money. 4 weeks, 3 months, or 1 year, up to you. T-bills are short term, so you can reinvest your money multiple times in a year, potentially compounding your returns. They don't have the highest returns, but they can sometimes outpace savings accounts or money market account interest rates. So if you're saving up to buy a home, let's say you have $50,000 for the down payment and you want a safe place to park it and make some extra money on the side, well, T-bills are a great option. You could buy, let's say $50,000, you buy a 6-month T-bill at a 4% annual rate, you could make about $1,000, which you can also reinvest. Again, it's not the most amount of money, but that can be used towards home inspection costs, appraisal costs, and even your closing costs. So might as well have your money do the work for you.